The question many Americans are beginning to ask is whether inflation is truly finished or whether it could return in a way that feels even harder to escape. For much of the past year, the Federal Reserve projected calm. Interest rates came down, inflation appeared to be cooling, and the markets have responded with optimism. On the surface, the system looks stable again, but monetary policy rarely tells its real story. Oftentimes, the most important signals are found in what policymakers hesitate to say. As we head into 2026, the Federal Reserve finds itself navigating one of the narrowest paths in modern economic history. Every move they make now carries consequences that extend far beyond interest rates themselves. What may be forming now is different from the inflation shocks of the early 2020s because it is quieter, slower, and more persistent. When inflation becomes embedded in everyday life, it changes character of what we consider normal. Prices may stop accelerating, but they never fall back down to previous baseline. And although households adjust, they may never catch up financially. It is this kind of inflation that dominates daily ordinary American lives and not the one in the headlines. The Federal Reserve understands this risk. That is why rate cuts have been cautious. Policymakers are trying to ease financial pressure without reigniting price instability, and this balance is increasingly difficult to maintain because the forces shaping inflation today are not purely monetary. As 2026 approaches, the Fed appears to be signaling a shift away from restraint and toward management, a move which may signal an attempt to stabilize conditions without triggering another shock. Although this is a sign of caution, the markets have interpreted this shift as reassurance, but markets and households experience inflation differently. Because while the markets react to expectations and speculations, households react to prices they cannot avoid. And even if inflation remains officially moderate, many Americans will continue to feel squeezed. This gap between official progress and lived experience is where inflation becomes psychologically powerful because when people stop expecting relief, they change behavior. They may start to spend defensively, it may become harder to save, and long term planning feels unreliable. And it is these behavioral shifts that can reinforce inflationary pressure in subtle ways. The Fed is acutely aware of inflation expectations, so if households and businesses begin to assume that prices will continue rising at a steady pace, those assumptions become self reinforcing. Avoiding that outcome is one of the Fed's core objectives, but doing so without triggering recession is increasingly difficult, and although the economy has historically absorbed higher rates, those has never come without cost. In this environment, inflation does not need to surge to become a problem, as its persistence alone is enough. A steady 3% inflation rate may sound manageable, but over time it erodes purchasing power, confidence, and trust, which turns stability into endurance. Another layer of uncertainty heading into 2026 is leadership transition, as Powell's term ends because markets and households listen carefully to tone, emphasis, and framing of any communication coming out of the Fed. A subtle change in how inflation risks are discussed can influence behavior across the economy. The Fed's credibility rests on its ability to convince the public that inflation will be contained. If that credibility weakens and policy becomes less effective, rate cuts will stimulate demand more aggressively, and rate hikes will lose their restraining power, drifting expectations upward. This is why the question of inflation returning in 2026 is not about numbers alone, but about trust. Trust in institutions, in policy. Trust that prices will not continue rising faster than incomes. There is a plausible scenario in which inflation does not explode but quietly reasserts itself through accumulation, and in that scenario, the Fed may find itself responding later than it would like. If 2026 delivers growth without relief, stability without comfort, or inflation without crisis, many Americans may feel more pressure than they did during the pandemic years, because slow pressure exhausts in ways sudden shocks do not. The Federal Reserve is trying to prevent that outcome but it is doing so in an environment where its tools are blunt and the forces shaping prices are complex. This does not mean inflation will spiral out of control, but it does mean that the risk profile has changed, that inflation may return as a background condition, one that shapes decisions quietly, persistently, and unevenly. As 2026 approaches, the most important signal may not be what the Fed does next, but how confident it sounds when it does. For households watching prices, paychecks, and savings, that distinction will matter more than any single rate decision because inflation does not need to come back loudly to matter. It only needs to stay long enough to be felt.